In 1694, a group of London merchants lent the English government £1.2 million so it could build a navy to fight the French. In exchange, they got a charter to open a bank. That bank, the Bank of England, is the real starting point of this story, because it solved a problem that had crippled every English king before it. Nobody would lend the crown money at a rate it could actually afford. Within a generation, that single fix let Britain borrow more cheaply than any government in Europe. And cheap, reliable borrowing turned out to be the seed of almost everything that followed: an empire, an industrial revolution, and 2 centuries as the wealthiest country on Earth. This is the story of how a damp island with modest farmland and some coal seams became, for a while, the economic center of the entire planet, and how the very same machine that built that dominance eventually took it apart again. Before 1694, English public finance ran on a kind of institutionalized panic. Kings borrowed from whoever they could find, usually at ruinous interest, because lenders had no confidence the debt would ever be repaid. A monarch's promise died with the monarch. The Bank of England changed the underlying deal. Parliament, not the king personally, now stood behind the debt, which meant the debt would still be good after any single ruler died. Lenders responded immediately. The interest rate the government paid to borrow fell from around 14% before the bank existed to roughly 8% at its founding, and down toward 4% within a few decades, while France's kings, borrowing without anything like this system, were still paying 10 to 15% and constantly running out of willing lenders. That gap in borrowing costs is not a footnote. It's the reason Britain could keep fighting and financing wars against a much larger, richer rival for the next 100 years without going broke first. Credit that cheap and that available inevitably went looking for places to be reckless with, and in 1720 it found one. The South Sea Company, chartered to trade with Spanish America, persuaded Parliament to let it take over a huge slice of the national debt in exchange for company shares, promising investors constant returns. There was barely any actual trade behind the promise. Share prices rocketed from around £128 in January to over £1,000 by August, driven almost entirely by people borrowing to buy shares so they could sell them to the next person borrowing to buy shares. When the confidence broke that autumn, fortunes evaporated within weeks. MPs and peers were expelled from Parliament for their role in it, and the government had to quietly absorb the wreckage by splitting the debt back out to the Bank of England and the Treasury. What's notable isn't the crash, it's that the underlying financial architecture, the bank, the market for government debt, survived it completely intact and kept functioning for the next 3 centuries. An early demonstration that London's financial system could absorb a genuine catastrophe without the whole structure coming down, a trait that would matter enormously later on. That same appetite for capital eventually found a far more productive outlet, turning coal and iron into machines. Britain sat on enormous, easily accessible coal seams, and in the early 18th century, iron makers worked out how to smelt iron ore using coke, refined coal, instead of increasingly scarce charcoal, a change that was both cheaper and produced better iron. Thomas Newcomen's steam engine, built originally just to pump water out of flooded coal mines, got a major efficiency upgrade from James Watt in the 1760s, and by the century's end, steam power could drive rotating machinery directly, not just pumps. None of this mattered on its own. What made it an economic revolution was textiles. Mechanized spinning and weaving let a single mill worker produce what had once taken a household of hand spinners weeks to make, and because cloth was something almost everyone on Earth needed and would buy, that productivity gain turned directly into exportable wealth rather than sitting unused. By the early 1800s, cotton mills powered by steam and coal were producing at a volume and price no handcraft economy anywhere in the world could compete with. That productivity boom had a brutal underside that any honest account of Britain's industrial wealth has to include. The same mills that could outproduce the world ran on labor drawn heavily from women and children, some as young as 5 or 6, working 12 to 16-hour days in hot, poorly lit rooms full of unguarded moving machinery for wages as low as 4 shillings a week. Parliament's 1833 Factory Act, one of the first pieces of industrial labor legislation anywhere in the world, banned employing children under 9 at all, capped the working day for 9 to 13-year-olds at 8 hours, and required a couple of hours of schooling alongside it, followed by further acts in 1844 and 1847 that extended similar limits to women. The industrial cities these workers packed into were, quite simply, killing them faster than the countryside did. An 1842 sanitary survey of Manchester found that a professional, or member of the gentry there, could expect to live to around 38, while an ordinary laboring laboring worker in the same city could expect to live only to about 17, a gap driven by overcrowded housing, contaminated water, and industrial air quality that barely existed as a concept yet. Britain's industrial wealth, in other words, was never distributed anything like evenly as it was being generated, and the country spent much of the following century through factory regulation, public health reform, and eventually the welfare state, trying to close a gap that the industrial boom itself had torn wide open. Getting coal, iron, and finished cloth to move at the speed this new industry demanded needed a transport system nothing in Britain had built before. And this is where railways turn from a curiosity into genuine economic infrastructure. In 1824, there wasn't a single mile of steam railway in the country. By 1830, George Stephenson had opened the Liverpool and Manchester line, the first to run scheduled steam, passenger, and freight service between two major cities, connecting an inland manufacturing center directly to a working port. By 1850, just 26 years after that first line, Britain had roughly 6,000 miles of railway track. What railways actually did economically was collapse the cost and time of moving raw cotton in and finished cloth out, turning what had been a patchwork of local and regional markets into something close to one national market, and eventually, through steamships and telegraph cables, one that reached into ports across the whole world. By the middle of the 19th century, Britain had a genuine problem that most economic superpowers eventually face. It could produce far more than its own population could consume, and it needed the rest of the world to buy the surplus. In 1846, Parliament repealed the Corn Laws, tariffs that had kept the price of imported grain artificially high to protect domestic landowners. It sounds like a narrow agricultural policy, but its real function was to open Britain to a genuinely free trade economic model, import cheap food and raw materials from wherever they were cheapest, export manufactured goods to wherever people would buy them, and let London's financial houses finance the difference. Between 1815 and 1870, this combination let Britain earn the nickname it gave itself, the workshop of the world, a country whose factories could outproduce and undersell almost any rival in almost any market without needing to conquer that market first. By 1913, Britain alone still accounted for roughly 48% of all bituminous coal mined in Europe, a staggering share for one country on a continent that included Germany and Russia. None of this ran on British soil and British labor alone, and it's worth being precise about where the rest of the capital came from, because oversimplifying it in either direction distorts the real story. Profits from colonial trade, including, in the earlier part of this period, the trade in enslaved people and the plantation economies it fed in the Caribbean, flowed into British merchant houses and banks, and helped fund the earliest rounds of industrial investment. Historians continue to debate exactly how large a share of total industrial capital this represents, but there is no serious argument that it was zero. At the same time, the bulk of the machinery, the mines, the mills, and the railways were financed domestically by British capital reinvesting British profits, and would very likely have industrialized on a similar path even without an empire attached to it. The honest picture is a country whose domestic coal, capital markets, and engineering talent did most of the actual industrializing, while colonial trade supplied an important, but not solely decisive, additional stream of capital and captive export markets on top of it. By the First World War, though, the machine that had made Britain rich started grinding against something it couldn't outproduce or out-trade its way past: the bill for fighting a war of that scale. Britain financed the war heavily through borrowing, much of it from the United States, and came out the other side for the first time in its modern history, not as the world's leading creditor, but increasingly reliant on American finance. Then, in 1925, Chancellor of the Exchequer, Winston Churchill made a decision that economic historians still argue about as one of the costliest peacetime policy mistakes in British history. He put sterling back on the gold standard at its pre-war exchange rate, roughly $4.86 to the pound, even though the pound's real value had fallen well below that during the war. John Maynard Keynes attacked the decision almost immediately in an essay pointedly titled "The Economic Consequences of Mr. Churchill," arguing that an overvalued currency would force British exporters to either cut prices and therefore wages, or lose sales entirely. He was right. Coal, cotton, and shipbuilding, Britain's old industrial backbone, became persistently uncompetitive against this overpriced pound, wages came under sustained pressure, and industrial unrest built toward the 1926 general strike. When the Great Depression hit in 1929, Britain was already carrying this self-inflicted wound, and unemployment climbed to roughly 17% by 1932. Britain's one genuine advantage in the Depression was cutting its losses early. In September 1931, it abandoned the gold standard altogether, years before the United States, and the resulting devaluation, painful as it was for national pride, made British exports competitive again and let unemployment roughly halve to around 8.5% by 1937. The lesson embedded in this decade is a strikingly modern one. A currency's exchange rate isn't just a number on a board, it's a lever that can make or break entire industries. And getting it wrong by pursuing prestige over economic reality can cost a country a decade of growth. The Second World War forced Britain to rebuild its entire productive capacity around a single output, war material, and paid for it in a currency that would define the following 3 decades: debt. Wartime spending was financed substantially through American Lend-Lease aid and enormous domestic and international borrowing. And by 1945, Britain's national debt had swollen to a size that would take generations to work through, a bill that came due gradually across the post-war decades, even as the country simultaneously tried to build something entirely new on top of it. The Attlee government elected in 1945 responded not by retrenching, but by nationalizing the coal mines, the railways, and eventually steel, bringing them under direct state ownership on the argument that industries this central to the whole economy shouldn't depend on private capital's willingness to keep reinvesting in aging, war-battered infrastructure, especially in coal mining, where decades of underinvestment by private owners had left much of the industry technically outdated well before the war even began. At the same time, it built the National Health Service in 1948 and a broader welfare state funded through taxation, a fundamentally different relationship between the British state and the economy than had existed before the war, one where government spending on health, pensions, and unemployment support became a permanent structural part of the national accounts rather than an emergency measure. For the next 3 decades, this arrangement, alongside a broadly full employment economy and steady, if unglamorous, growth, became simply how Britain expected its economy to run, even as economists at the time increasingly worried about a recurring pattern nicknamed stop-go, where governments would stimulate the economy to reduce unemployment, watch inflation, and import bills rise in response, then slam the brakes on with higher interest rates and tighter budgets, only to repeat the cycle again a few years later. That post-war settlement held together reasonably well for about 3 decades, propped up partly by rebuilding, partly by full employment, and partly by a fixed international currency system that limited how badly any one country's problems could spiral. Its limits, though, were exposed with startling speed in 1956, and the episode is worth including precisely because it shows how thin Britain's financial independence had actually become. When Britain and France invaded Egypt to retake the Suez Canal after its nationalization, investors began selling the pound, and the Bank of England had to burn through its dollar reserves defending its fixed exchange rate. Britain needed emergency financing from the International Monetary Fund to stop the bleeding, and the Eisenhower administration made clear that Washington would block that support, and reportedly threatened to sell down its own holdings of British government bonds unless British and French forces withdrew. Facing the prospect of a currency collapse it had no independent means to prevent, Britain's government pulled its troops out within days. It's a purely financial mechanism producing a geopolitical outcome. A country that could still, on paper, project military force across the Mediterranean discovered it could not do so without American permission for its own currency to survive the attempt, a clear signal that the post-war sterling area's global reach now rested on reserves London no longer fully controlled. It came apart in the 1970s, and the mechanism is worth spelling out plainly. Rising oil prices after the 1973 OPEC embargo pushed inflation to its highest levels since the Napoleonic Wars, hitting a British industrial base that was already less competitive than its German and Japanese rivals, who had rebuilt their factories from scratch after the war with newer equipment. Labor unions, understandably trying to protect real wages against that inflation, pushed for large pay increases, which fed the inflation further. a genuine wage-price spiral. By September 1976, the pound was under such sustained pressure that Chancellor Dennis Healey had to turn to the International Monetary Fund for a $3.9 billion loan, at the time the largest the IMF had ever issued, the first time a major developed Western economy had been forced into that kind of supervision. The conditions attached, deep cuts to public spending, marked a real break from 3 decades of post-war consensus that the government's job was to spend its way to full employment. When public sector strikes over pay restraint paralyzed the country during the so-called Winter of Discontent, spanning the end of 1978 into early 1979, uncollected rubbish piling up in London's streets, grave diggers refusing to work, the political and economic exhaustion of the old model was complete, and it created the exact opening Margaret Thatcher would step into in 1979. What Thatcher's government did next amounted to a deliberate, large-scale demolition and rebuild of the relationship between the British state and its industries, executed with genuine economic conviction rather than incidental drift. Between 1984 and 1988 alone, the government sold off British Telecom, British Gas, British Airways, British Airport Authority, and British Steel, while steadily divesting its shareholding in British Petroleum from 51% state-owned in 1977 down to fully private by 1987. The largest single sale of the era, British Gas in 1986, turned a state monopoly into a publicly traded company almost overnight. Alongside privatization came the deliberate confrontation with the National Union of Mine Workers in the strike of 1984 and 1985, a year-long industrial battle the government was determined to win, having stockpiled coal in advance specifically to withstand it, and which ended with the union defeated and the coal industry's decline, already underway for economic reasons, accelerated sharply by policy on top of it. North Sea oil, first coming on stream in meaningful volumes through the 1970s and 1980s, gave the Treasury a genuinely useful cushion through this transition. Oil and gas tax revenue peaked at more than £12 billion in 1984 and 1985 alone, money that helped fund the costs of a rapidly shrinking industrial workforce, even as it was, ironically, also being spent down through the same era's tax cuts and privatizations. The other half of Thatcher's transformation happened not in the coal fields, but in the City of London, and it may ultimately be the more consequential change of the entire decade. In October 1986, in a set of reforms nicknamed the Big Bang, the London Stock Exchange abolished fixed trading commissions, ended the old rigid separation between the firms that advised on trades and the firms that executed them, and opened the market to foreign ownership and electronic trading almost simultaneously. American and other international banks poured into London within months, and the city transformed from a somewhat clubby, domestically dominated exchange into one of the 2 or 3 largest global financial centers on Earth, competing directly with New York and, later, Tokyo. This is the pivot point where Britain's economy genuinely changes character. Manufacturing's share of the national economy, which had been around a third as recently as the 1970s, kept sliding for the rest of the century, while financial and business services grew to fill an ever larger share of the gap, eventually accounting for something in the range of a fifth of the country's entire economic output, heavily concentrated in a few square miles of central London. That concentration of financial power delivered enormous wealth for decades, and then in 2008 delivered the clearest possible demonstration of its risks. Northern Rock, a mid-sized mortgage lender that had grown rapidly by borrowing heavily on international money markets rather than relying mainly on ordinary customer deposits, suffered the first run on a British bank in 150 years in September 2007 when those wholesale credit markets seized up, queues of depositors forming outside branches on live television. Within a year, the government had nationalized Northern Rock outright and was pouring public money into propping up Royal Bank of Scotland and Lloyds, 2 of the country's largest lenders, injections that eventually totaled somewhere in the region of £45 billion for RBS alone and around $20 billion for Lloyds to stop the entire banking system from failing simultaneously. It's the same lesson the South Sea Bubble taught in 1720, replayed on a vastly larger scale. A financial sector this large, and this interconnected with the rest of the economy, is not a self-contained industry that can simply be allowed to fail. When it breaks, the state ends up as the buyer of last resort, whether it wants that role or not. So what does 230 years of this add up to sitting here in the present? Britain today is, by most measures, a services-dominated economy, with finance, insurance, and business services doing much of the heavy lifting that coal, cotton, and steel once did, and London remaining alongside New York, one of the two cities that genuinely sit at the center of global capital flows. That's a real, durable strength, built on the same underlying asset the Bank of England created in 1694, a reputation for stable, enforceable financial contracts that the rest of the world is still willing to trust with its money. But the same 2 centuries also show, over and over, what happens when that strength isn't matched by investment in the industries and regions it left behind. Manufacturing's share of the national economy, close to a third as recently as the 1970s, has fallen to roughly a tenth today, and the old mining valleys and shipbuilding towns whose economic role never really got replaced with anything at comparable scale still show up decades later as some of the poorest regions in the country, sitting uncomfortably close to a London economy that, by some measures, produces 2 or 3 times the output per person. The same currency and debt mistakes, an overvalued pound in 1925, an underfunded state in 1976, a banking system too large to fail in 2008, keep recurring in different costumes across 100 years. Britain's economic story was never really about coal or empire or the pound sterling on their own. It was about a country that built, almost by accident in 1694, an unusually good machine for organizing other people's money and other people's trust, and then spent the next 3 centuries finding out exactly how much that machine could build and exactly how much damage it could do when nobody was minding what it was actually financing.